Hi guys, welcome back to Working Capital Management. Up next, financing the working capital. Now, working capital management is the management of the daily activities of the business. Again, this involves the changes in our current assets and current liabilities, the current items. Working capital management is divided into two: the management of current assets, which includes cash, accounts receivable, and inventory, and financing the working capital. Management of current assets pertain to the left side of the balance sheet, where to put the funds for working capital. On the other hand, financing decisions is about the right side of the balance sheet, where the funds came from. We are now going to the latter, the financing decisions on working capital. We will be talking about where the funds come from. To start, let us talk about trade credit. Trade credit is a financing source coming from trade suppliers. Technically, it is also known as accounts payable. Trade credit appears to be free, or is it? Now, to understand the issue regarding the cost of trade credit, let us refer to the following case. MCC Corporation is offered by its supplier HMM Incorporated trade credit terms of 210 and 50. MCC Corp does not take advantage of the discount and it pays the account after 62 days. Using a 365-day year, what is MCC Corp's approximate annual cost of not taking the discount? From the case that we have presented, there is no mentioning of interest or finance charges. However, it doesn't mean that trade credit is absolutely free. As it can be noted, MCC will pay less if it is made by day 10. That is a 2% discount. 2% less than if it would have to pay thereafter. Let us go to the timeline to appreciate this scenario. From day 0 to day 10, that is the discount period. From day 11 to day 50, that is the remainder of the credit period. Although per policy, the account should be paid by day 50, MCC in reality is actually paying on day 62. So let us consider day 62 instead. Now, if MCC will pay by day 10, the amount to be paid will only be 0.98 of the price. But if MCC will forgo the discount and pay on day 62, the payment should be 100% of the price. This is after 52 days. That's from day 10 to day 62. Now, considering there is a difference here, and this difference is due to the passage of time, it can be safely said that this is actually interest in substance. From day 10 to day 62, that's a total of 52 days. And the amount to be paid would be 0.02 over 0.98. So to arrive at the approximate cost of financing with the use of trade credit, we have the following. 2 divided by 98, which pertains to the additional amount to be paid after day 10. Annualizing this rate, we have times 365 days per year divided by 52 days. Again, this is an annualization adjustment. We have an approximate cost of financing 14.32%. Now, again, trade credit is not absolutely free. It actually has an implicit cost. When we say the cost is implicit, it is hidden. It is hidden in some other form. In the credit policy, nothing was mentioned about interest charges or financing charges. But in substance, there is actually such a charge. Let us move on to another source of financing. Let's go to the bank. Let's talk about bank loans. Obviously, bank loans are financing coming from banks. Now, unlike accounts payable, the cost of bank financing is stated. It is clear. Or is it? Now, here comes an issue when arriving at the true cost of financing. The interest rate stated can be misleading due to terms involving discounting and compensating balances. Let us refer to the next case to demonstrate how discounting and compensating balance can affect the true cost of financing. MCC Corp wishes to borrow funds amounting to 10,000 from GNB Incorporated at an annual interest rate of 10% for 1 year. Now, if we are interested in knowing the effective annual rate pertaining to the true cost of financing, it is quite straightforward if it is a simple loan. To arrive at the effective annual rate, the amount payable as interest is 10% of 10,000. Then the amount of principal borrowed is 10,000. So 10% of 10,000, that's an interest of 1,000. Again, this is the amount to be paid as interest expense. Simply divide it by the amount borrowed of 10,000. You have an effective annual rate of 10%, equal to the interest rate stated. Again, for simple loans, it is as straightforward as that. Whatever is stated, that is the effective annual rate. Next, what is the effective annual rate if it is a discounted loan? When we say the loan is discounted, what we mean is that the interest is immediately deducted at the time of borrowing. The amount of principal is not to be given in full to the borrower. The borrower will simply receive principal less interest. So in substance, the amount the borrower borrowed is not equal to the principal. It is principal less interest. To arrive at the effective annual rate, we would have an interest of 10% times 10,000. And the amount borrowed is not 10,000. So we will divide this by 10,000 minus 10% of 10,000. So we would have an effective annual rate of 1,000 divided by 9,000, 11.11%. As you can see, with the discounted term of the loan, the effective annual rate is actually higher than what is stated. Thus, this is one of the things that banks do in order to increase the effective interest without stating it to be as such. But what about compensating balances? What is the effective annual rate if it has a compensating balance of 2,000 pesos? So compensating balances are actually amounts that the bank would restrict the borrower from withdrawing from their account. As such, the amount that they actually borrow would be the principal less this compensating balance. So we would have an effective annual rate. Interest is 10% times 10,000. We're going to divide this by 10,000 less the compensating balance of 2,000. As such, the amount actually borrowed is only 8,000, the amount that's usable for our borrower. So we would have 1,000 divided by 8,000, that is 12.5%. Again, through the use of compensating balance, just like discounting terms, it can increase the effective or true cost of financing without presenting it to the borrower as such. In reality, however, banking regulations require that the lender should state the true cost of financing. In other words, there should be a disclosure about the effective annual rate. So these are just some of the financing sources for working capital. So if we need cash, AR, and inventory, where do we get our funds? Trade credit and bank loans. Now, for other sources of financing to fund our working capital, stay tuned for the next video. Like, share, and subscribe.